A wave of 800 billion in multifamily debt is maturing. Rent growth is slowing, insurance costs are surging, cap rates are recalibrating in real time. But this isn't a collapse. It's a realignment, a consolidation. Institutional players aren't playing defense, they're hunting, and they're targeting precise geographies, asset classes, and operator profiles. They've done this before. After the dot-com crash, after 2008, each time they scooped up value while retail capital hesitated. This cycle is no different. Only this time, the scale is unprecedented. Billions in dry powder, faster data, more aggressive underwriting teams. They're not just looking for upside, they're looking for control. And they're about to reshape the market for the next decade. So here's how they're mapping it. 1. Demographic gravity zones. These are metros with 3 traits: inbound migration, diverse job growth, landlord-friendly regulation. Your top picks: Dallas-Fort Worth, Tampa, Nashville, Raleigh-Durham, Columbus, Ohio, Richmond, and the Hampton Roads in Virginia. They're not choosing these markets by accident. They're using migration data, school enrollment trends, and U-Haul indexes to track movement in real time. See, these cities aren't just gaining people, they're gaining momentum. Momentum in wage growth, STEM employment, and state-level incentives. If capital flows follow confidence, then these are the markets full of conviction. They offer more yield, they offer narrative. In a time when investors are desperate for clarity, these metros offer predictability. Not perfection, but resilience. They also offer depth in employers, in industries, and consumer demand. And institutions are looking for sticky fundamentals, markets that just don't get rocketed by one factory closing or a single employer leaving town. They want layers: government, healthcare, logistics, education. The more insulated the economy, the more scalable the risk. And these metros, they're not just insulated, they're accelerating. 2. Class B and C submarket clusters. Institutions aren't chasing shiny new Class A towers. They're buying 1980s and 90s product with value add potential in zip codes with high median household stability. Targets: suburban submarkets with school district leverage, secondary metros with low new supply, workforce housing corridors near regional medical centers. Why? Because affordability is now a competitive moat. And Class B assets, when upgraded thoughtfully, generate outsized rent increases without regulatory exposure. Think 18,000 per unit capex to drive 300 plus month rent bumps. That's ROI traditional markets can't touch right now. These aren't sexy deals, but they cash flow, and they resist volatility.